Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, more earnings rolling in. We'll have the highlights from Goldman Sachs, Morgan Stanley, and BlackRock. Plus, Ford CEO Jim Farley weighs in on the state of the auto industry. We'll take you to the floor of the Detroit Auto Show. And Intel focusing on the basics, how the company is taking a different approach to its business amid the AI boom. Let's get a check on what's going on in markets right now. The three major averages right now are trading higher. The Dow getting a boost of about 200 points at the moment. The S&P 500 up 0.5%, and the Nasdaq up almost 0.75%. Also want to point out we're seeing some new record highs, at least on an intraday basis, for the S&P Equal Weight Index, as well as the Russell 2000. So interesting to see that action. Within the S&P 500, it's really tech coming back today that is helping support the gains, supporting the gains in the Nasdaq as well. The XLK up 1.5%. On the downside, we've got healthcare shares a little bit weaker today. But to point out what's going on within tech, of course, a lot of this has to do with what's going on with TSM, Taiwan Semiconductor, coming out with numbers that beat estimates here and really helping the whole complex, if you will, raising its capex forecast for the year to $52 to $56 billion. And that confidence is lifting the semiconductor group and really the AI ecosystem more broadly. So you see here pretty much all green with a few exceptions going on within the semiconductors. And then just one more thing I wanted to get a check on and update you on, and that's these two guys in the middle of your screen here. Morgan Stanley and Goldman Sachs both turning higher after their conference calls here. Initially, we saw sort of a middling to negative reaction in those two on the back of a lot of positive gains for the stocks. But now they've turned higher as well. Really, a lot of them beating, both of the banks beat on most of the metrics that we track. Well, President Trump saying he has no plans to fire Fed Chair Jerome Powell in an interview with Reuters. This comes after the Justice Department launched a criminal investigation into Powell, causing concerns about the future of Fed independence. Our Federal Reserve correspondent Jennifer Schonberger live now with Federal Reserve Governor Michael Barr. Jen?
Thank you, Julie. Governor Barr, thank you so much for sitting down with me. It is great to have you on Yahoo Finance.
My pleasure to be here.
I want to start the conversation with the grand jury's subpoenas that were served to the central bank by the Department of Justice and the investigation into Chair Powell. How did you learn about it? And when you did, what was your reaction? How did you feel? How do you see this?
Well, I think Chair Powell's statement from last Sunday was clear and direct on this point. It is an assault on the independence of the Fed, as was the earlier assault on Governor Cook. And I think these are just examples of the ways in which the independence of the Fed is being challenged. And I want to assure your listeners that we are acting only for economic reasons. We are acting only according to our congressional mandate. That's to make sure that we have price stability and maximum employment. That's what we've been focused on all along, and that's what we will stay focused on. Are
you worried that the independence of the Federal Reserve is under threat, and will you personally take steps to protect that independence?
As I said, we are acting only for congressionally mandated reasons. We're acting only in order to assure maximum employment and price stability. That's what we have been doing. That's what we will be doing. And the best way to demonstrate that to the American people is to do that.
Let's talk about inflation. We got some new readings on inflation this week. CPI on a core basis has been sitting at 2.6% for the past 4 months. We also got some readings on wholesale inflation. How are you looking at inflation now, as well as specifically the impact of tariffs on prices? And how much signal are you taking from the data now, given that we are still seeing a bit of a lingering impact from the government shutdown?
Well, the recent inflation data reinforces the concerns that I've had that inflation remains elevated. In core PCE terms, it's been hovering at about 3% over the last year. Services prices inflation has started to come down. Goods price inflation has been rising. Those are kind of offsetting. The balance is that inflation has been too high over the last year. We had a period of time where we made substantial progress from 2022 to 2025. That progress right now has flattened out, and we need to continue to do the work necessary to bring inflation all the way back down to our 2% target. Tariffs are having an effect on prices. We're seeing goods prices rise. The question is, will that be a one-time event where they rise and then they're done rising, and then we'll start to see inflation fall back towards our target? Or might we see persistence of that? And that's really what I'll be focused on the inflation front.
And what's your perception now? Do you see a risk of inflation becoming persistent, especially when you looked at the Beige Book and we saw some of the anecdotal evidence there, when you looked at the PPI report?
Well, I do think we're going to continue to see goods prices rising in the early part of this year. I think a reasonable base case is that price increases stop going up once tariffs are fully incorporated into prices. But there's a significant risk that they don't, and that's the risk that we have to watch out for. So we're looking at the labor market, we're looking at the inflation side, we're balancing those risks. I think right now we're in a good place in terms of our interest rate policy to be able to take some time and really assess the inflation effects over the course of the next year.
I do want to get to the path on policy, but you also mentioned the job market, and the Fed cut rates 3 times the tail end of last year on concerns about the job market.
Right.
We got the December employment report. The unemployment rate dropped to 4.4%. Do you think things are stabilizing now in the job market, albeit perhaps at a lower level?
The job market does appear to be stabilizing. It's a little early to know for sure. We're still working our way through the data. It'd be useful to have some more data at the early part of next year to assess that. As you said, it's stabilizing at a very low level. So if you look at net job creation, it's hovering close to zero. The reason that the unemployment rate has stayed low and has stopped going up is that labor force growth is also very close to zero. Both those numbers might be a little positive, they might be a little negative, but if you think about it, we're not seeing a lot of dynamism in the labor market. On the positive side, it's a very low firing environment. We're not seeing a lot of layoffs of significant size. But on the downside, we're not seeing a lot of hiring. We're not seeing a lot of net new job creation. And so when you have that kind of low level of activity in the labor market, that does present a risk going forward that we need to watch carefully.
When you look at both sides of your dual mandate, are you more worried about inflation now versus the job side, or how are you looking at things now?
I think the risks are pretty much in balance. That's why I think that we're in a good place in terms of interest rate policy to look at those risks going forward. A reasonable base case is that the labor market is continuing to stabilize and that inflation will continue to come down to 2%. But there are risks to both sides of the mandate, given the low level of job creation, risk to the employment side, given the potential persistence of inflation, risk to the inflation side of the mandate. So I really do think we're going to have to take some time to really assess the incoming data. Really until the spring, we're going to have effects of the government shutdown playing into biases in the data for technical reasons on both the employment side and the inflation side. So we have to try and make adjustments for that. We need to treat the data, with some caution, and that will play through really into the spring.
So we're less than 2 weeks away from your policy meeting. You said you're in a good place with policy right now. If the meeting were tomorrow, would you hold rates steady?
Well, we always take things on a meeting-by-meeting basis. We still have a couple weeks till the meeting. I would say that I think we're in a good place on policy. We can take some time to make a judgment about how the economy evolves, how the data is evolving, what the forecast might look at, the balance of risks. But right now, I think we're in a good place.
Looking farther out towards the end of the year, I recognize we're in January. A lot of things can change. But do you perceive any adjustments to the policy rate, perhaps later this year, any rate cuts?
Well, I don't think it makes sense to lock in. We really need to know what is the data telling us and how is our forecast evolving, how are the risks evolving. But I think we can take some time really to assess the incoming data because our policy is in a good place. It is balancing both of those risks, I think, quite well. Right now, we're in what most people think of as the wide range of neutral. Mm-hmm. And so it's really important for us to be careful to take our time to get it right.
How restrictive do you think you are right now?
We're really in the range of neutral right now. Mm-hmm. So,
okay.
You can think of estimates around that, but.
Okay. Sort of switching gears, President Trump sent to announce a new Fed chair soon. We know that he wants someone who is in favor of lower rates. How do you see the dynamic of a new Fed chair playing out with the rest of the committee? Do you see any shifts to the Fed being able to act independently?
I think that the committee, the FOMC, is set up in such a way that a new incoming chair, like any chair, has to get the trust and confidence of the whole committee in order to make changes in policy. So the chair has to act based on data, has to act based on reasonable forecasts and an assessment of those risks in a way that convinces other members of the committee that moving or not moving is the right thing to do. So the checks and balances that are built into the system will keep the Fed independent and focused on our goals.
Governor Barr, thank you so much for your insight. I so appreciate it. Welcome to the conversation there.
My pleasure. I really enjoyed it.
Thank you so much. That's Federal Reserve Governor Michael Barr. Julie, I'll send it back to you in New York.
Jennifer, thank you so much. Appreciate it. Coming up, we're breaking down the latest earnings action in the banking sector. Stay tuned for more market catalysts. Bank earnings are in focus with two of Wall Street's biggest players delivering fourth quarter results. For more reaction, let's bring in Stephen Bigger, Director of Financial Services Research at Argus, and Devin Ryan, Director of Financial Technology Research at Citizens. Guys, thanks so much for being here. It's been an interesting morning, hasn't it? Because Goldman and Morgan Stanley both reported the stocks kind of languished a little bit and then have been perking up after the conference call. Devin, you and I were emailing a little bit as I was trying to get my hands around what was going on there. In your mind, what were sort of the key things that were said on the calls that maybe turned the sentiment here?
Yeah, good morning, Julie. So, I think that the point is the bar was really high for these companies heading in. So even though they both beat numbers pretty nicely, that was kind of baked in expectations. I think most on the buy side assumed they would beat. So then therefore, it all became around what they were going to say on the call and what they were going to give in terms of kind of new targets. Were they going to address the old targets and update? And Morgan Stanley, they didn't increase the return on tangible common target, which I think most people were hoping they would. But positively, they addressed it on the call. And effectively, I think investors are walking away feeling like, yeah, they'll probably continue to beat that number. And it's just more out of conservatism. So I think that's the Morgan Stanley nuance. And so people feel quite a bit better exiting that call. And then Goldman Sachs really kind of came out swinging on their old targets, particularly around asset and wealth. And I think setting a much higher bar for themselves and reaffirming their mid-teens ROE through the cycle or kind of over the medium term, but with the expectation that there's a lot they can do on capital, still kind of $30 billion plus of buyback authorization, and that's going to be a tool. So I think people also feel pretty good there with a very constructive capital markets tone on the call, plus some self-help here as we go into 2026. So it was really about the outlook because we all knew that the quarter itself was going to be really strong.
Yeah, and speaking of outlook, Steve, Goldman in particular, that equities trading revenue number was just kind of incredible there. A record for any bank ever at $4.31 billion. Do you expect the momentum, not just for Goldman, but for some of the other capital markets businesses across Wall Street to continue to see that performance?
Yeah, Julie, we do. I mean, this is a unique environment, obviously, for the investment banks right here. It's really a perfect storm in a good way. You've got a great backdrop. You've got good fiscal, monetary policy. You've got rising boardroom confidence. You had global announced M&A deal value was up over 40% in 2025. So I think a lot of those deals still haven't closed. So there's some of that backlog still that will generate into revenues and moving into this year. So. It's really across the board. I mean, it's the trading volumes have been good based on volatility. It's across equities and fixed income, currency, commodities. The M&A story, continues to stay high. The boardroom confidence is getting better. There's a lot of competitive pressure on the side of corporates to either grow revenues or cut costs, which can be done through M&A. That more favorable regulatory environment that we've talked about most of this year, adding to deal demand, and particularly these mega deals, especially in vogue with a lot of that driven by the need for scale, whether it's across technology, industrials, financial sectors. So all combined, that's a very good backdrop for this year. And let's not forget falling interest rates and more favorable financing terms, right? So it's been the market has been willing to absorb new debt, new equity, and that is a prerequisite to keeping that M&A story going.
And the banks themselves have also been engaging in some M&A. And with Goldman in particular, obviously the big headline was selling that Apple Card portfolio to JP Morgan. Devin, in the wake of that, do you feel like the course correction at Goldman out of that consumer business is complete? Do you expect any other additions maybe at Goldman this year, maybe on the asset management side? Or do you think that this is the Goldman that David Solomon wants and that the street wants?
Well, I think this is the Goldman that the street wants, and that course correction, I think, is, to your point, that the Apple movement was like the primary remaining piece there, and so I think that's an important moment for the firm to really think about the future. And then to your question around incremental opportunities, I still think they're going to be looking at M&A. They've done some tuck-in, particularly in the asset and wealth side, and I think that's an area where they can still grow. They're putting up some really big targets for the alternatives business, where they are expecting $75 to $100 billion of net inflows annually in that part of their business. So very focused on kind of leveraging expertise and scale there. 2030 target for $750 billion in alts AUM. So that's like as big or bigger than most of the publicly traded alternative asset managers today. So I think they're really showing that this is an area, and it has been going on for the last several years, but where they can differentiate Goldman's franchise, and also an area where I think you'll see continued growth focus, M&A, to your point, and the point around kind of capital relief and excess capital. And there's a lot of ways you can both reinvest that back into the business to grow. You can return it to shareholders through dividends and buybacks, and they increased their dividend today by 50 cents. And they talked about being selective on buybacks, but that's still being an important tool. And then you can do M&A, and I think that's very much on the table, and maybe increasingly so, just with with some of the capital changes and regulatory relief that we're seeing here.
That said, Devin, I do want to follow up on that, because you do have a market perform, a neutral equivalent rating on Goldman and on Morgan Stanley. Are they just too expensive right now?
We've been bullish on both these companies for quite some time in the not too distant past year, and we've just gotten to a phase where we do think that the valuations are reflecting a lot of our enthusiasm. And so there's a couple things going on. The fundamentals could not be better, and you hear that from the call today, and things are actually getting better into 2026. And I think that's supporting investor enthusiasm, and a lot of active managers rotated into these names early in 2025. I think a lot of the incremental buying over the last 6 months has been more passive. So you had $30 billion of net inflows into ETFs and financials, which is massive for financials over the last year. And so I think that's been a big piece of driving the valuations to where they are today. So we feel like they're getting a lot of credit, but I think when you take a step back, if you have a 3 to 5 year horizon here, I think you do well. In the very near term, we're taking a pause to try to digest some of the recent stock move. But, I think it's the valuation versus the fundamentals. Fundamentals really couldn't be better, and I think are actually accelerating. And in some ways, today's update was even marginally better than I think people were hoping for.
And Steve, you're weighing it a little bit differently because you have buy equivalent ratings on both these guys. So do you see any risks out there to that upside case that you have?
Well, I think as Devin said, the consensus about the profit growth this year is probably intact. A lot of things could happen, obviously, on the global side or regulatory or what have you to upset that story. But no, I think this is a stair step higher for valuations for these banks. Even a Morgan Stanley, I'd say 15 times next year's earnings. You've got this incredible backdrop, I think, of a strong momentum that's likely going to be here, several years, as long as the present administration is helpful with that backdrop, whether it's the fiscal policy, the AI trade that, as I mentioned, the need for corporates to get more efficient and grow revenues. So, there's a lot of capital markets formation that's possible here, and I think generally when you have this move higher in the capital markets trade, generally you'll get a stair step higher in valuation. So I think it has a little bit longer to run here. I think at least through the administration currently, and we'll take a pause potentially after that. But these banks are in great shape, and typically the valuations themselves I don't think are a hindrance at this point.
And Steve, while I have you here, before I let you go, I want to ask you about two other companies in your coverage that also have been affected by some things going on with the administration in a different way. I'm talking about Visa and MasterCard because of the rhetoric that we've heard from the president about the 10% credit card rate cap. And what's interesting here is pretty much everybody we've talked to has said, it ain't going to happen, right? The banks are against it. They don't think it's a good idea. It's not getting traction in Congress. And yet, we have still seen some of these stocks under pressure. In the case of Visa and MasterCard, kind of like a delayed pressure. What do you think is going on there, and is there any threat here?
Well, I don't think the news on the 10% interest rate cap was all that surprising. Candidate Trump had talked about this on the campaign trail in 2024. And there was a Senate bipartisan legislation that was proposed, Sanders and Hawley, last February as well, talking about that. So, I think it is just a long road. I mean, even Speaker Johnson has talked about the heavy lift that this is likely to be. I'm not clear on a 1-year deal for this and what that will necessarily accomplish. I expect there's probably some sort of a compromise in store, which means that banks have talked about being more innovative, more inventive about the credit card offerings. I think there could be more tiering with credit scoring and so forth. Not everybody needs to pay that 16 to 20% or higher on their credit card. So I think you could bring that average rate down without doing much. I think the industry is going to be extremely vocal about the downsides of this when you look at credit availability and so forth. That it's U.S. credit card lending went over $1 trillion in 2023. It's now about 1.2 trillion. I think there needs to be more education on how that's a really imperfect form of financing for consumers generally. But I think MasterCard and Visa, as the processing networks are a little bit removed from this, they don't have to worry about the lending side. To the extent it upsets the business model a bit, but there's been such a long-running transfer of to digital payments from cash and checks that they've got a very long runway for growth on the processing side, and I think that's behind some of this. But I agree, the headline risk remains here, and we're going to have to see how that plays out at the regulatory level.
We will indeed. Stephen, Devin, thank you so much. Appreciate it.
Thanks, Julie.
Coming up, we'll hear from Ford CEO Jim Farley about EVs, F1, and challenges the company's facing this year. That's next on Market Catalysts. The auto industry facing a reset, from a rethink of the EV timeline to uncertainty around tariffs and trade. Yahoo Finance's Pras Subramanian sat down with Ford CEO Jim Farley at the Detroit Auto Show to talk about all of that and the rising competition in China.
Number one is we're a year down the road with the Chinese competitors. They're now even more prominent around the globe. Not a lot here in the US, but you go to Europe, you go to anywhere else, China's a big deal. Number two is partial electrification, hybrid, EREVs. EVs are now starting to change, and the partial electric world is actually the most exciting part of the, and then I would say, tariffs are still a big topic. And that's something that's very much on our mind in managing.
Yeah, I know President Trump talked about, do we need USMCA for Canadian products? I know you have thoughts on that.
Yeah, USMCA is critical for our country. We developed the whole assembling automobiles across all three countries. We need revisions to it. It's not fit for purpose today. The tariffs do change a lot about the aspects of USMCA, but for a company like Ford, who makes the most number of vehicles by far in the US, like 80% of what we sell are made here, our competitors aren't even close to that, the mainstream competitors. This is a critical negotiation. It should start sometime this spring, and I think every customer should care deeply about USMCA.
You mentioned China as well, and their EV prowess sort of front and center with the industry.
Yes.
Ford with the pivot last year at the end of the year, kind of going more towards the smaller EVs and E-revs and
that's right,
and however you want to say it.
Exactly.
What do you think the industry, Ford, even us journalists and Wall Street got wrong about the EV transformation, or is it just a delayed sort of onset?
No, it's not delayed. I think it's actually different. I always portrayed it like a baseball game. We were in the second inning. Most people thought we were in the 8th inning. We were actually in the second inning. We're now going in a third inning. And I think all of us, should be humbled by the fact that we're at the very beginning of this journey. We are not in the middle or the end. Battery tech, infrastructure, it all changed a lot. It took us 100 years to build out the petrol infrastructure. The electric infrastructure is going to take a lot of time. It may not take 100, but it's going to take time. I think what we got wrong, I think what we all got wrong is, look, policy has a huge impact. When President Trump says no EPA rules anymore, that is a game changer for the companies. We were artificially selling EVs and hybrid at mixes that were not in line with customer demand. Now we're doing that, and that changes your allocation to capital. But I think anytime a new technology, software-defined vehicles or electrification, both of those are separate, but they're connected. When they rip through a new industry like auto, you got to understand that in the first couple innings, it's going to keep changing differently than we think. And I like to say those pesky customers, I love that term because the customers are awesome and they act rationally. They're not going to buy a $70,000 vehicle that only goes 300 miles if they don't really want to charge on the fly on a long trip. And we drive long distances in the US. And we found out they're just not going to do it. Some people will do it at a Tesla Supercharger now, or a Lightning customer or Mach-E, but most customers like, nah, I'll buy a hybrid, and we think they'll buy an E-Rev. That is a really cool tweener technology.
Yeah, that Lightning E-Rev coming up in a couple years, but
I think people will be shocked. It's an all-electric vehicle.
Yep.
It is not a hybrid like the F-150 hybrid. It doesn't have a gas powertrain to drive the wheels. The gas powertrain is an industrial engine to charge the batteries. It's a completely different vehicle, but for towing, work use, long distance, it's an electric vehicle that can power itself with gas charging.
I know you did that EV road trip in America, and kind of curious how that would be with the E-Rev, right? Maybe a different story altogether.
Yeah, I wouldn't
right?
stop. I wouldn't be stopping at Supercharger networks or Charge America. I'd be stopping at gas stations.
Speaking of gas stations, we're in Detroit, Motor City. You guys unveiled 2 cars here, specific cars, enthusiast cars.
Yes.
The Dark Horse SC, which is sitting right there across the way here. Also the Bronco RTR.
Yes.
2 different products, but targeting enthusiast customers.
Yes.
Why is it important for Ford?
That's our whole brand, no more boring cars. What I love about both products is Vaughn is something new for Bronco.
Vaughn Gittin.
Vaughn Gittin Jr., like his whole DNA was a drifter. So like Ford's working with him on an off-road vehicle, but he's been racing at Baja with us. And he loves off-road racing. And also the SC, it's not Shelby. It's something different. We're going in a different direction now. We really want to connect our vehicles to racing. With the Mustang Challenge and our GT4 and GT3 race cars. We really see Mustang lineup being built out around as an enthusiast brand. Yes, you could rent one in Florida and drive it down to the Keys as a convertible.
That's not a bad idea.
But I think we really feel like Porsche shouldn't be the only brand having fun, and we're going to do it in a Detroit way and differently. We want to make a stick shift affordable V8 coupe, unlike some of our competitors here in Detroit. But we also want a drift RTR Mustang. We want a supercharged, more affordable version of the GTD. We want a GTD. We want Bronco to not be just the old style off-road. We want Vaughn Gittin Jr. to remix an off-road category. We are not going to be stale trail people only. That's what's fun about being in the car business. We want to challenge ourselves to reinvent the enthusiast products on and off-road in a way that maybe people didn't expect.
I know you're really hot on Dakar and
Yes.
with the Bronco there, and you guys, knock on wood, have a good finish there. I know.
Yeah.
I know you want to talk about that, but also we got to mention season launched
Formula
today.
One, yep.
Formula One.
Yes.
Ford returning to the
Yes.
top flight of motorsport.
Yes.
You know, it's kind of it's a big deal, obviously, for American fans and for the F1 in particular. But it's not just a marketing exercise, which many people thought, right? It's beyond that. It's engine and DNA, right?
Yeah, we've been working for 4 years. We have lots of engineers in Milton Keynes. It's been a lot of work for 4 years. Today we get to celebrate that, and then we'll be on track in Barcelona and beyond. It's going to be very challenging. We are not like Ferrari and Mercedes have been building a PU for 20 years. The DFE got us to the third most winning brand in Formula One with our power unit. But the tech transfer is no longer 4 valve per cylinder and overhead cams. It's now, predictive failure components and software that we can put in a transit van, or, more aero that we can put in the new UEV affordable electric vehicle, or high discharge batteries that we may use in a performance hybrid system, that we can transfer from Formula One. So the tech transfer, and that's kind of our bet in Formula One on the PU side, the power unit, is really to move that tech into our core product, but not in the old school way of powertrain. It'll be in areas like, batteries, software, and aero.
And real quick, so Red Bull basically is leaning on you guys for hybrid tech and things like that, right?
Yes,
More than they thought they would?
Oh, for sure. I mean, we've had a lot of surprises the last 4 years. It's been a lot of hard work. We brought a lot to the table. I'm really proud of my team. We've been 3D printing components for the PU and shipping them over there. We have actually engineers flying over to Milton Keynes with prototype parts over the last 4 years because our 3D printing capability was higher than the Formula One teams. We have a lot of experience with hybrid. We have a lot of experience with control software. And we can bring a lot to the table that even a great Formula One team like Red Bull doesn't have the resources of Ford Motor Company. But in the end, this is a really huge mountain to climb. We're very humbled by this approach. We've been involved we have so many engineers involved in the project. We really know how hard this is. Some of our competitors, even crosstown competitors, are racing Ferraris and other people's PUs. We're going to do it ourselves. And because it's hard. And there are no guarantees.
It's good that you have a test driver like Max Verstappen to test that technology. We'll talk to him later today. But quick last question. I want to talk about Detroit Auto Show and Ford, the connection to the city.
Yep.
You guys are doing a lot here. Why is this so important for Ford?
Well, because we believe in the rejuvenation of Detroit. It's Henry Ford's home. We invested over $1 billion in the train station.
Here, right, yeah.
We're really proud that people can come here and see what Detroit will be now with the tech hub. And we never walked away from the Detroit Motor Show. A lot of our competitors did. When they went bankrupt, they didn't spend money. Last couple of years after COVID, we always had test tracks. We have always had introductions. We love our Detroit Motor Show. It's our home event, and it's also a huge charity event for the community. I think for us, the Carhartt partnership really captures the spirit of the company. Tools for technicians, training to get more technicians in our dealerships, Carhartt stuff for our employees. We love Carhartt. It's older than Ford. It's a Detroit company. It's for people to work with our hands. Other than enthusiast products, what we're really good at is work products. Like Pro, like Transits and Super Duties, and we really love Carhartt as a brand. I can't wait for people to see the Carhartt Super Duty. If they thought the Harley truck was cool a few years ago, they are going to love the Carhartt Super Duty.
Yeah, I saw the reaction with Ford employees at the event cheering, and I'm really
awesome.
Happy about that. So Jim, thank you so much for having us. I'm looking forward to the event tonight.
You're going to have a good time, and have fun with Max. Try to get him to smile. He's a stone cold killer, but underneath there is a human.
I'm going to try.
Good.
Thank you.
Have fun.
Coming up, we're looking at some of today's trending tickers and top analyst calls. Stay tuned. You're watching Market Catalyst. Welcome back to Yahoo Finance. I'm Brooke DePalma, live with the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Dell, Intel, as well as DraftKings this morning. First up, Dell. Barclays upgraded the stock from equal weight to overweight. The analyst said it's now more positive on the company because AI server orders are strong, its profit margins in AI are stable, and there are more opportunities in servers and storage. Plus, the firm views Dell as, quote, best in class in managing expenses. The street is pretty bullish on the name with 24 buys, 5 holds, and 1 sell rating on the street right now. Next up, Intel. Citi upgraded the chipmaker to neutral from sell. The analyst said it should benefit from advanced packaging supply tightness at TSMC, Taiwan Semiconductor. The analyst said Intel has a unique window of opportunity to attract foundry wafer customers. The street is mostly on the sidelines with this one, with 8 buys, 36 holds, and 8 sells. Lastly, DraftKings. Wells Fargo upgraded the sports betting platform to overweight from equal weight. It expects DraftKings to exceed the implied high end of its fourth quarter guidance of $273 million to $287 million. There are now 31 buys, 8 holds, and no sells in the street. Pretty bullish view on DraftKings. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session. Now time for some of today's trending tickers. We are watching oil stocks, Talon Energy, and Bitmine Emergent Tech. Market data editor Jared Blickry is joining me now to chat about these. So first of all, we got to look at what's going on with oil stocks as we are watching underlying oil prices as well. ExxonMobil, Chevron, ConocoPhillips are pulling back as Iran tensions appear to be cooling. President Trump is seemingly backing away from threats of military action against Iran. So again, we've got those underlying oil prices lower.
Yeah.
And then the oil stocks are following suit, Jared.
Yeah, let's start with the charts here. Let's go to the Wi-Fi Interactive, where we're taking a look at our mostly large cap energy heat map here. You see a lot of red. You mentioned the majors. A few green spots. One of them is Talon Energy. We're going to be talking about that in a minute here. Another is BKR is Baker Hughes Company. I'll just show you the 1-year chart on that real quick, and you can see up about 12%. But this is kind of a lowering of that geopolitical risk premium. And I'm going to go now to a chart of WTI crude oil, which trades pretty much in lockstep with Brent. This is what's happening today, down 4.5%, biggest downdraft in about 2 months. I was just checking. Here's a 5-year chart, and we're pretty close to 4 or 5 year lows right now. I'm trying to draw on that line there. But if you want to see what real geopolitical risk looks like, okay, this was the original invasion of the Ukraine by Russia way back in 2022. And that's when oil prices shot up to $130 intraday per barrel. And so we are just at the lower end of that. And so we are in an environment now where there are a lot more bearish forces than bullish, which is good for consumers. The U.S. Energy Administration expects global inventories to build 2.8 billion barrels per day in 2026. So kind of gluttish talk here. And it's going to take a lot more than the current situation in Venezuela, Iran, Black Sea, any kind of hiccups there to really shoot the price of oil higher. You really, unless something threatens the Straits of Hormuz, and that's that really narrow channel in the Middle East where all that oil flows, or something big like that, another huge invasion, I just don't see the price of oil really getting above $70 per barrel.
Yeah, I mean, you could have events in Iran affecting things on the margin eventually. But as it was, even with the rhetoric starting to heat up, there was no actual disruption to supplies at this point. Right. And there were still a lot of questions about, even if there was regime change in Iran, and all of that was highly speculative, again, what effect would it have on the actual supply? But now President Trump seems to be backing away and saying that he's been assured that the Iranian government is going to no longer be killing protesters. Mm-hmm. They called off an execution reportedly. So we'll see what happens with all of that. Talon Energy, you mentioned that one. It is continuing to expand its portfolio. The power producer is adding on natural gas generation capacity through the acquisition of natural gas assets from Energy Capital Partners. Now, this is not like an energy company like a big oil company. This is more like a power company or a utility company, right? And we have seen a lot of those companies really fly over the past couple of years because they've been providing power to data centers. Yes.
Yeah. They so thirsty for that electricity, those data centers. And you put that very well. So I'll just go over some of the deal basics here. $2.5 billion in cash plus $900 million in stock. And that cash is going to be financed by the bond market, most likely. This will add 2.6 gigawatts in Ohio and Indiana. There is some regulatory risk. They're going to have to clear what's called the Hart-Scott-Rodino Act. I had to look that up. That's a Federal Trade Commission rule. They're also going to have to clear FERC, that's Federal Energy Regulatory Commission, and the state of Indiana. Sorry, if we let's go back to the Wi-Fi Interactive there. I'm going to pull up Talon Energy. That was that big green spot. I'm going to show you the last year. They've been flying high. Yeah. You know, this was the time when all the utilities, all those boring utility companies, energy companies, were catching a bid. And you can see it's actually kind of flatlined over the last few months. Got a bit of a bid today. That's up 10%. So whenever you see a stock going through an M&A or kind of a deal transaction where it's going to cost a lot of money, but the stock is up anyway, that just means they're going to benefit from a lot of synergies. Going back to our heat map real quickly, let's put the 1 year on, and Talon Energy really stands out. I'm sorting these by performance, and here it is in the upper left, up 82%, a lot more than any of the oil majors or some of the oil miners.
Yeah, and they have a sort of diversified portfolio. So they have natural gas generation already. They have some nuclear generation too, and then a little bit of coal and oil, I guess. So we'll see how much this changes the balance of that generation. Finally, let's talk about BitMine Immersion Technologies. It is betting on creator-based platforms. It's an Ethereum treasury company. Tom Lee is the guy who's the chairman of that well-known investor. And the company is making a $200 million equity investment into something that is most definitely not crypto. It's Beast Industries, Mr. Beast company. Like, could you, I feel like this is the memeiest story you could possibly imagine.
Tom Lee, Mr. Beast.
Tom Lee, crypto, Mr. Beast. You just put it all together. But the stock is not higher today.
No, it costs money. And so this is kind of the opposite of what I was just talking about with respect to that energy transaction. This is going to cost some money here, and it's being taken out of the stock. And a lot of these treasury companies, whether it's Bitcoin or Ethereum, they get the money from the capital markets through the sale of stock a lot of times, not even the bond market necessarily. And so you will see the stock take a big hit like this just because investors expect to get diluted. That's an intraday chart you're looking at on the Wi-Fi Interactive. Let's show a max chart. You can see still up 300%, although we are well off of those initial euphoric highs. I thought it'd be interesting to compare Ethereum, the price of Ethereum to BitMine here. So let's go over 3 months, and you can see BitMine is actually down 16-17% there. That's Ethereum, and that is higher up here. That's down 16-17%, while BitMine is down 42%. This reminds me of Bitcoin versus Strategy, and we have seen the premium sucked out of these treasury companies recently. But I will say, I was just noting the other day that Strategy is almost outperforming Bitcoin over the last month. So on these smaller time frames, it looks like there's a bid on kind of money moving back into crypto, and the speculative fervor that has catapulted a lot of these stocks and a lot of these coins up before is in the very beginning stages here. I don't want to sound too optimistic, but it looks like things are kind of coming around here. I will also say, why Mr. Beast? That's a big question. I just think it's a meme. It's a meme opportunity, and you kind of have a tie into the creator economy. It gains attention. If they want to pivot at some later date, they've got a captive audience there, and so it's when you're involved in a meme-ish business, that's it seems maybe like a natural extension.
Well, Tom Lee in the statement says, Mr. Beast and Beast Industries, in our view, is the leading content creator of our generation. Beast Industries, the largest and most innovative creator-based platform in the world. Our corporate and personal values are strongly aligned. Have you watched the new season of Beast Games yet?
I have not.
Maybe Tom Lee can be a future contestant.
That would be amazing. I would love to talk about that on Trending Tickers one day.
That would be interesting.
See what BitMine does.
Thanks, Jared. Coming up, how Intel is starting the year strong by focusing on the basics. Intel shares hit 52-week highs on Thursday with enthusiasm over the chipmaker's sold-out AI CPU capacity and reports of a potential partnership with Apple. But at CES, Intel took a more back-to-basics approach, focusing on how its new chip will perform rather than touting its AI features. Yahoo Finance tech editor Dan Howley was there at CES watching all of the action and the back-to-basics approach of Intel. So tell us about what you thought the vibe was from them.
It was honestly very high. I mean, outside of NVIDIA, I think the vibe for Intel was probably the biggest. Mostly because this is their first chip that they're launching on their 18A platform. This has been their kind of long gestating technology that they've been working on. And it's important in that this is key to their turnaround effort. I got to see the chip itself. Also in Lego form, it was pretty cool. And see it running on these different devices. And so, they're saying 27 hours of battery life. That would be better than what you get from a MacBook Air or a MacBook Pro. And Apple really kind of went ahead with this kind of idea of performance and long-lasting battery life, and that's really been a boon for it. AMD did the same thing. Intel was kind of left in the dust. Qualcomm's come in and said, hey, we could do that. Now Intel is getting that together. And so I didn't get to try out the battery life on these things, but I will say I did get to try out some games, which is a good estimator of how good the performance is. And I was blown away. I mean, this is stuff that you wouldn't see from an Intel chip or any other chip, really, as far as capabilities go. And so that, I think, is something that was really worth noting, that they just kept talking about 27 hours of battery life, the NPU that they have, which, that runs AI apps. I think the reality is most people still use AI in the cloud. They don't necessarily use it on device. And, while Intel is still talking about the AI PC that Microsoft likes to plug, that Copilot Plus PC. I do think that generally the overall vibe was, hey, we have a great chip now, and people should be excited about this. And so that's what I think the big takeaway was. And for a company like Intel to kind of do this 180, to go from, cool, we got chips, to, hey, we have a great chip coming out and we're going to be building on that, I think was really huge.
Well, and now there's some speculation about like Intel in talks with Apple about regaining them maybe as a customer. What do we know about that, and what should we be looking for?
Yeah, this was a report a while back, but well before CES, and then the other day, President Trump was getting off or getting on Air Force One. It was a gaggle that he was doing at the press, and he had kind of had an offhanded comment about helping Intel with Apple. So that could lend to the idea that perhaps this deal that was originally reported is coming to fruition. Regardless, it would be incredibly interesting, just from a technology industry watcher, because Intel was originally in Apple's MacBooks.
Right.
Didn't do that well. Apple wanted more control over design. Now they're potentially saying, we'll go back to Intel because your chips are doing
right,
well.
Or maybe even invest in Intel in some way.
I mean, that would be huge.
Unclear what it is, but we'll be watching it. Thanks so much, Dan.
Big turnaround, maybe.
Yes. All right, that's it from Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.